Good afternoon, everyone. I'm Eileen Doherty, and I'm the director of the Colorado Gerontological Society. And it's great to have everyone join us this afternoon. Our topic today, as part of our Aging in Place series, is called "Is a Reverse Mortgage Right for You?" And so we'll start out this afternoon just a little bit about what is a reverse mortgage. Basically, a reverse mortgage is a loan. It is a loan, though, that is on money that you have already used. As with any mortgage, it is money that you borrow and that at some point in time, it does have to be paid back. So understanding that you are borrowing money, but it's different than a traditional mortgage. So how do you qualify? Well, there's some basic requirements. One is that you have to be age 62. And the way that a reverse mortgage works is that you borrow against the equity in your house. So if you have a house that is worth $300,000, and if you own it free and clear, then the equity in your house is $300,000. If you own a house and it is worth $300,000 and you have a $150,000 mortgage on it, then the difference between the $300,000 and the $150,000 that you owe is $150,000. So that becomes your equity. I should have probably used a different example, such that if your house is worth $300,000 and you owe $175,000, then your equity is $125,000. So basically what you want to do is, if you owe any money on your house, whether it's a first mortgage, whether it's a second mortgage, whether there's a lien on your house for some reason or other, whether it's a mechanic's lien, whether you have used money and used your house as like collateral for a short-term loan, any type of a loan, or you've used your house as collateral, the difference of that is basically your equity. In a reverse mortgage, then basically any monies that you are due in this amount of money that you are going to borrow can be distributed usually in three ways. It can be distributed as a lump sum, could be distributed as a monthly payment, or it could be sitting there as a line of credit and you only use it if you need it for whatever that reason might be. So again, let's go back to our example of a $300,000 home. And our equity at this point in time on this example is $175,000. That's what the amount of the reverse mortgage might be. In that instance, I could take the entire $175,000 and I could use it for whatever I need. I could also decide, as an alternative to that I don't want the full $175,000 at one time, but I would like to have $1,000 a month in income to supplement either my current Social Security, my rental income, my investment income, and I would like to have an additional $1,000 a month. So what I could do then is I could have the lender send me a check every month for $1,000. The third way that I could get access to my $175,000 is that I could have it sitting there as a line of credit, and I could only use it if I needed it. So in that instance, sometimes, say we had a situation where my car broke down and I had to purchase a new car, and I didn't have money in my regular monthly budget to be able to afford a new car. So then I could either have the money taken out in a lump sum. So say I go buy a new car or a different car for $20,000. I could then, on the line of credit, just pull out the $20,000 that I need for the purchase of the car. And then the other $155,000 would be there should I need it in the future. It's important in terms of reverse mortgages to know the difference between what we call a forward mortgage versus a reverse mortgage. So a forward mortgage is what most of us are used to. This is a loan that has to be paid back on a regular basis. This is the type of loan that usually most of us have put into place when we purchase a home, when we purchase a car, when we make any other type of purchase where we go to the bank and we ask for money. We agree that we are going to get that amount of money. We're going to pay a monthly payment. On a forward mortgage, there is principal and interest that have to be paid back. So again, the principal would be the $175,000 on the previous example. And then there is an interest rate. The interest rate can vary depending on who the lender is and what the government or the Federal Reserve sets the mortgage interest rates at. So, for example, over the last few months, the interest rates have been increasing. So let's say, for purposes of our discussion, that the interest rate is 3%. So for every month that I am borrowing the $175,000 on my forward mortgage, I would pay a certain percent of that back, as well as the monthly interest. A forward mortgage has also what we call a term. And what that term means is how long, how many months, how many years am I borrowing that money, and over what period of time am I going to pay it back? So on a forward mortgage, my $175,000, if it was a 10-year term, means that the first year I would have to pay back $17,500 plus the 3% interest on that, which is around $5,400 or $5,100. So that would be the amount of money that I would have to pay approximately over the first year. They have what's called an amortization table that is used by the lender, and every month or every year when you make a payment, it decreases the amount of the loan, and so the amount that's paid back is not a fixed amount that I can do the math totally in my head. I would have to look at the amortization schedule, and then based on that, I would know exactly on my $175,000 loan, if I was paying it back over 10 years on 3% interest, what the amount of my principal is that I would pay back on month 12, as well as the amount of interest that is paid. Usually in these, in a forward mortgage, especially if you're looking at your home, the home becomes the collateral. And what collateral means is that if you are not able to pay the loan back, then the value of the home can be used to guarantee to the lender that they will get their money back. And they get their money back through a process called a foreclosure. And the foreclosure basically means that the lender will sell your house to a new buyer. Sometimes that's done on an individual basis. Sometimes it's done at an auction. There's different ways that that is handled. But then whatever the proceeds are of that sale, then in a forward mortgage, the lender gets paid. And then if there's any money left, either it goes to you or it will go to your estate if you have passed away or anybody else that you may have designated. Now that's what most of us are used to, and it's called a forward mortgage. Reverse mortgages have been around probably for somewhere in the neighborhood of 25 to 30 years. They've been around for a long time. The difference between a forward mortgage and a reverse mortgage is that it allows you to use the equity in your house as cash. So in our example, again, we have a $300,000 house that has $175,000 in equity. So what we do then is that we can borrow money based on that equity. And the loan is not paid back every month, but it is paid back when the title of the property changes. So the title would change usually in a couple of different ways. It will change when you sell the house, or it would change when you passed away, because now the house would be owned by your estate. And then whoever buys the house from the estate would then put the name of the title in their name as opposed to the estate. So when one of those two actions happen is when the loan becomes due. The government makes sure that a loan never exceeds the value of the home. So you as the borrower always have enough equity to pay off the loan. And they do that because, again, they don't want you to borrow more money on your home than you would be able to pay back when the title is changed, whether that's because you sold it and you moved to something else or because you died. The home is used for this type of a mortgage as collateral as well. And again, the same basic principles apply. So how does a reverse mortgage work? So the lender in this case pays you this amount of money that you have been approved for. And as I said earlier, you can get it monthly, you could get a lump sum, or you can get this line of credit idea. What is different then is that you still have to pay interest on the amount of the loan that you receive, not on the total amount of the loan available. So one of the reasons that it often makes sense for you to have this line of credit is to have it as a line of credit is that, as opposed to a lump sum, is that in a line of credit, you take out the money as you need it, and then you pay interest on the money that you have taken out. Interest is rolled into the loan. And what that means is that the interest is payable when the loan is paid. So instead of having to make a monthly interest payment, it just accrues in addition to the amount of the money that you have taken out. So if you take out of your line of credit, you have $175,000 line of credit, you take out $20,000, the interest rate is 3%. You pay basically 3% of $20,000, which in a year is approximately $600. So that was all the money that you ever took out of your reverse mortgage, when you went to pay it back, you would pay back the $20,600. That's what rolled into the loan means. It just becomes part of the amount of money that you own, and it decreases then the amount of equity that you have in your home. One of the things that's confusing to people is that they think if they do a reverse mortgage, that the mortgage company is going to take the title to your house. The mortgage company does not take the title to your house for the reverse mortgage. That title is retained by you, the homeowner. And the loan then is paid back, as I said a few minutes ago, when either the title changes or you, the homeowner, pass away. So what happens when the title changes? So the mortgage balance has to be paid. So if I have a $175,000 loan, I've only used $20,000 of it, and I had a 3% loan, then I pay the $20,000 plus the interest of $600. So I pay back $20,600. In addition to that, you have to use mortgage fees or mortgage insurance, not fees. Mortgage insurance is the way that we guarantee that if for some reason or other, the amount of money that you either take out of your house and the value of your house decreases rather than increases, then mortgage insurance is what pays the difference between whatever the collateral / sale price of your house is and the amount of the loan due if there is a shortfall. And sometimes we do see that there is a shortfall for various reasons. Sometimes the housing market will collapse, and a house that was worth $200,000 this year is only worth $100,000 or $150,000 next year. And as a result of that, if you had to pay back your reverse mortgage and you had taken out $200,000 and you could only sell it for $150,000, then the mortgage insurance would pay the $50,000. The other thing that becomes due and payable at the time when the title changes is if there are any fees, such as servicing fees, closing costs, loan origination fees, or title searches. So a service fee is basically the amount of money that the lender is allowed to charge each month for sending you a check and processing the paperwork. They can be annual charges or they can be monthly charges, depending on the lender. Closing costs usually look like things like how much money do you have to pay to get the loan? And the closing costs usually include any amount of taxes that you owe at the time, and this is property taxes, at the time the loan is secured or the loan is closed. Other things that can go into the closing costs could be insurance costs, liability insurance. There could be some outstanding utility bills that are due. There could be a fee to the realtor or the lender who put the loan together. So those are the kinds of things that show up in the closing costs. Loan origination fees. This is the amount of money that the lender is going to charge you to actually get everything ready. So these origination fees have to do with negotiating the amount of money that you need. It has to do with, doing the various paperwork, doing credit checks. Those kinds of things are what go into loan origination fees. Another thing that can either be part of the loan origination fees sometimes you see the fees as separate, sometimes they're part of the closing costs, is a title search. And one of the things that a title search does is it tells the new buyer or the lender in this case, that you in fact are the actual owner of that property. And it identifies if there are any loans or encumbrances against that property. It also tells you whether or not there are any easements or who else has access to your property. So for example, a title search might show that the utility company has an easement to bury the public service electrical lines underneath your right-of-way on the side of your house. That would be an easement that they would have. If there is an old lien against the house because somebody didn't get paid for something, that would come up in a title search. If you have an existing mortgage that you owe to a different lender, that would come up and show in the title search. So what they're trying to determine in a title search is whether or not you have what's called merchantable title, meaning you have the right, you are the owner to use this property. The second thing they're trying to figure out is if there's any easements or liens against the property and whether or not there's any underlying indebtedness or mortgages. And once those fees have been paid as part of this, the title, when the title changes, then if there's any excess fees, then that money, if you're still alive and you just moved someplace else, those funds are paid to you. If you pass away, those funds are paid to the lender or to the estate. So taxes and benefits. One of the things that some people are hesitant, if you will, to accept a reverse mortgage is what happens if you borrow money. The Internal Revenue Service considers any money that you get from a reverse mortgage as a loan on equity, and they don't charge any income tax on it. So basically, it's your money, you invested it in your house. That money is an investment that either grew or may remain static, or in some instances decreased, but it's your money. So you don't, and you've already paid income tax on it when you purchased the house. So they don't consider that you have to pay taxes a second. Another thing that happens sometimes is if older adults are on certain types of government benefits. So if you receive old age pension, or you receive food stamps, or you receive other types of funding, then the question is whether or not this becomes income to you and you have to claim it, and then you lose your food stamps or your Medicaid or whatever. Most government benefit programs exclude any money that you get from a reverse mortgage as monthly income, because it's your money and you're just using it to pay your bills. So most of the time it's excluded, and it usually, or it has to say that in whatever the enabling legislation is and the rules. When our agency advocates with either the state or federal government for these types of benefits, we always advocate that any monies from any type of program be excluded from your benefits so that you do not lose them. Now, one of the things that happens, and there's probably someone on this call who it's either happened to themselves or they know it happened to a friend or a family member, is that they go to apply for benefits, or they go to get their recertification for benefits, and the County Department of Human Services counts their reverse mortgage as income and then disqualifies them for the program. So if that happens to you, you should definitely let the County Department of Human Services know that you have a reverse mortgage, provide them with the paperwork, and then they can make the adjustment so you don't lose your benefit. So a big question now is, now that we understand a little bit about how this reverse mortgage works, how can it help you to age in place? So probably the most important thing is that this money is very flexible. Nobody is going to look at you and tell you how you can or cannot use this money. So for a reverse mortgage, it could be money that you use to go on vacation. It could be money that you just want to have sitting in your account in case you need money for an unexpected purchase. Could be money that you're going to use to buy a new car. From an aging in place perspective, what I mostly recommend to people is that you use it for the purpose of purchasing home care. So say, for example, you really don't want to move, but you need some help and you don't have enough money to hire a homemaker to come in, somebody to help you with a bath, somebody to clean your apartment, do shopping, those kinds of things. That is a very, very good use of dollars, is to use these monies to help you stay in your own home and buy those kinds of services that you are no longer able to do for yourself. And yes, the money, or what you have to pay out, can be sometimes feel like it's expensive. But my question is, if you would prefer to stay in your own home, then it's an expenditure that is well worth considering. Another thing that people use reverse mortgages for sometimes is it helps you pay unexpected expenses. So over the many years that I have been in practice and working with older adults, I have seen people who thought they had an adequate amount of monthly income and or savings to pay for their monthly needs. However, as property values have increased, one and other costs of living and their longevity has also continued into many years longer than they may have planned for. Things like their property taxes increase or their insurance has increased. So again, because the money is flexible, it can be used to pay your annual taxes and insurance. Some of the loans include that, if you will, and they just automatically pay those taxes and insurance out of the existing money that is in your line of credit. Another way to use money to age in place is for either what I would call repairs or for home modifications. So one of the things that happens frequently is that as people age in place, they require different kinds of support. So you may find that you now require something like rails in your house, or you may require ramps, or you may require a walk-in shower, or you may need to make some changes or modifications to closets or to kitchen cabinets. You may need to move your washer and dryer out of the basement, and you have all this plumbing to do to move your washer and dryer onto your main floor. So those are the kinds of expenses, if you will, that oftentimes when we look to help people age in place, we have to make those changes and those modifications to the home. And as we're making those changes and modifications, frequently people do not have the cash flow to do that. So a reverse mortgage, again, is a way to pay for those upgrades, those changes, those additions, so that you can continue to live in your own home. And then lastly, another way that a mortgage can help you age in place and keep your own home is it can provide an income source when you quit working. We see a lot of older adults in today's world who continue to work. And many of them will tell us that they work because their Social Security or what other income that they had planned on for their later years is not enough to meet their monthly expenses. So they will continue to work. They're not able to continue to work. Using a reverse mortgage is another way to replace the income that you were getting from employment with this reverse mortgage. So where do you get a reverse mortgage? Usually mortgage companies that offer reverse mortgage specialize in this type of lending. There's a lot of television ads. There's a lot of, if you just Google it on the internet, you will find a lot of different names and companies come up. Some traditional banks might offer reverse mortgages, but they're less likely than the standalone mortgage companies that specialize in that. And then there's a special type of a reverse mortgage called a home equity conversion mortgage. This is the one that we try to recommend. And the reason we try to recommend it is because it is a loan that is basically supervised and backed, and the oversight for the loan is done by the Federal Home Administration, or the FHA. The requirements to meet or to get an FHA loan on the borrower is a little sometimes more strict or stringent than some of the other types of loans, but you as a consumer are much better protected. So if you consider this type of reverse mortgage, definitely do the home equity conversion mortgage, because that will give you better protections. There are some companies that the Gerontological Society works with who specialize in reverse mortgages, and we are happy to share the names of those companies with you, should you want that type of referral. And as I said, you can Google them, or what as another way to get them, or ask family and friends. The HECMA mortgage, or the charges, are the ones that I went over a little while ago. So they're definitely going to make sure that you have mortgage insurance. The third-party charges, these are things like title searches. These are things like once the money is dispersed to you, then the name of the reverse mortgage company has to be recorded with the clerk and recorder in the county in which you live. So there's always a fee associated with that. And there might be some other charges involved as well. The title company, for example, will charge to do the title search that we talked about. The origination fees on a HECMA are capped at $2,500, or 2% of the first $200 of the value of the home, and then 1% over the first $200,000 up to $6,000. Similarly, the servicing fees are capped, and they're $30 a month if the rate changes annually, $35 a month if it changes monthly. That kind of concludes my comments, if you will, today on a reverse mortgage. If you have questions, you are welcome to put those questions in the chat, and I will try to address those as they are put in the chat. And you can do that while I kind of finish the conversation at this point in time, which is just to let you know a little bit more about some of the programs that we offer. We offer vision, hearing, and dental grants to low-income seniors. We did get new money for all three programs and have approximately $1 million to spend in those programs. On the vision and hearing program, you must live in the Metro Denver area. The dental program, you must live in the Metro Denver area, but you also can live anywhere west of I-25. And we are in all of the counties up to the Wyoming, Utah, and New Mexico borders, including Boulder and Larimer counties. We offer advanced care planning services, which are services that can provide for you as you are looking at end of life decisions, or when you are unable to make decisions for yourself. We have a telephone buddy program in which volunteers call older adults once or twice a week to check in on them and make sure that everything is okay. We are planning our 33rd annual Salute to Seniors, which will be August the 12th and 13th. It will be virtual. It will be from 11 to 1 both days. We have a pretty exciting lineup of presentations. So the American Society on Aging out of California will be presenting a session on redefining retirement for baby boomers. AARP is going to talk about what older workers contribute to the workplace. The Pharmaceutical Research and Manufacturers Association is going to talk about some of the new science related to both medications as well as adaptive devices and infusion and those kinds of things. And I will be doing a session on aging in place and using technology. After midnight, a jazz band and Madison Quinns will be playing for a for the closing entertainment. Both days there will be prizes. We will have resources on the porch if you want to come by and pick up additional information. So there'll be a lot of things going on in addition to some online trivia and different contests, etc. We also do Medicare and Medicaid counseling, as well as other counseling on senior issues. Our senior resource guidebook is being distributed this week to local libraries. We have mailed copies to most libraries, and by the end of the week, hope that we will have them distributed and or mailed to most libraries. So if you have been waiting to get a new copy of that, you're welcome to go to the library, or we will have those available as part of our resources on the porch at the Salute to Seniors. We also have our housing locator program. If you are looking for any type of assisted living, nursing home, independent living opportunities, or home care, hospice, or adult day programs, you can go to our website at senioranswers.org and you can do a search on a number of different criteria. This particular program will be available on our YouTube channel, probably either later today or tomorrow as part of our Aging in Place playlist. In addition to that, we will be sending out the slides as well as a link to the video should anybody have any questions. So with that, I am going to conclude this afternoon. And if anyone has any questions, please go ahead and put them in the chat. Otherwise, thank you for your attention, and we will visit with you soon.